I'm David Saito Chung, a senior writer at Investors Business Daily. And since 1999, I've been involved in the writing and editing for nearly all of the market columns. Big picture, of course, on A1, the Investors Corner column, our daily educational piece, and in more recent times, actually, the Income Investor. And lately, I've been heavily involved as part of a core team of writers and editors who select stocks, write the analyses, and annotate the charts for Leaderboard, our new premium service that launched in July last year. Some of you might know that I spoke about this topic in 2006 and 2007 at our CanSlim Masters Certification Program. And over the years, a number of people said they really like to hear this topic again. And so I feel very humbled for this opportunity to speak to all of you on this very important topic. Now, we know IBD is a wonderful resource for helping you find great stocks. In fact, not just great stocks, the best stocks in the market. IBD also teaches you a complete system of investing, from the selection to the buying to the holding to the selling. So, with that in mind, why is it sometimes kind of difficult to sell at the top, right? If we have a big stock, we bought it correctly, but we didn't sell as high as we would have liked to. What causes that? I can think of three major factors. The first being the market itself. Sometimes it's more choppy than usual. It can be a very volatile market and cause us to get knocked out of the stock. And as you know, IBD stocks tend to be much more volatile than the regular stock you see in the Dow Jones Industrial Average, right? So that's one factor. Second factor is the mass media, specifically the business media. It's such a big industry, and because of technology and the way the world works, you see headlines and information speed across the globe instantaneously. For that matter, although in general the business news media does a good job of relaying important news and information, they also provide headlines that can be sensational, news that might not exactly be entirely truthful, and therefore distort your perspective about the reality of the situation and the stock itself. The third factor is something that unfortunately we can never get rid of, and that's emotions, right? We all have emotions. And I think that is a part of the trick of learning how to sell for big profits. Has anyone ever gotten a little afraid of losing their gains in a stock and therefore sell a big winner too early? Could I get a little mea culpa here, please? Yeah, myself included. I've had many of my own share of mistakes. And so when I looked at these past trading errors that I had, I realized that although I was following rules, although I was following IBD's system to a T, I still made mistakes because I was lacking one crucial ingredient, and that is conviction. What is conviction? Well, Webster's dictionary defines it as the state or appearance, but more importantly, the state of being convinced as of the truth of a belief or an idea. Conviction is a strong belief in something, right? And so this is really one of the core skills that each of us can master with time, with knowledge, and with recognition of how important it is in order to be able to hold a fantastic stock from the pivot point, from that buy point, through normal corrections, and hopefully near the peak as possible. Now, Justin has done a little work for me already by introducing the way that Bill, founder of IBD, who started this paper back in 1984, how he builds conviction in a stock. You might say that a picture is worth 1,000 words, and it looks like there are probably 1,000 words on this picture as well. But you can see that this is truly a reflection of one of Bill's greatest skills, being able to sit tight in a great stock. Well, how does he sit tight? He prepares. Conviction is a little bit about preparation. And this was a stock, eBay, as you know, that had tripled from its buy point here at the end of the bear market in 2002. And I hope that each one of you will go home, maybe you have a long plane ride, or take a Saturday afternoon and just look at every single one of these 66 little notes. These were handwritten notes, by the way, that Bill wrote. And so I really tip my hat off to to Justin for not only trying to read Bill's handwriting, which was actually quite good, but he actually typed all these in to make this a little more palatable. And you'll see that this graph, in fact, comes from the institutional service of William O'Neill & Company, the data graph. But a lot of it is incorporated into MarketSmith and Investors.com. And I just want to point out just a couple things. One, that here was a stock when it was early in its run, already at the top of its game in terms of earnings. 99 EPS, very, very strong annual earnings increases. In other words, Bill was truly full of conviction in his own system, the CanSlim system. Here's a guy who truly dines on his own cooking. But in addition to this, what I learned in studying his notes was that he learned enough about the company to really understand the true essence of what makes this company great. And this essence can sometimes not be really truly measured quantitatively, as you can see with a lot of this chart. For instance, look at number 52 here. As he read a bunch of articles about eBay, it came to him that this insight is eBay is really an online big discount store, number 54, that has no inventory costs. And because everyone who sold and bought products on eBay, they were keeping their own homes and garages and attics, eBay didn't have to have these warehouses and facilities to hold it. Therefore, with that lower cost, it was able to achieve these tremendous earnings and sales increases. And so here was a company that was truly doing something new. Not only that, here's another thing that's really kind of hard to measure, but Meg Whitman, being CEO, had a very good track record and a lot of experience in business that helped her make this company even greater than it was before. She had worked at Bain & Company and Disney, some big names here, had an MBA at Wharton. So here's a person at the top of the management who really had the tools, the experience, and know-how to grow this company. And that's, in fact, what she did. Now, we all can't be Bill O'Neill, right? We're all our own unique individuals with individual strengths and weaknesses, but we all have, obviously, a passion for investing in the market. And we all have the ability to grow our own conviction in the best stocks in our portfolio. And so I've created a framework here that I hope can be helpful for you as you prepare your journey in these great stocks. And this pyramid, it used to have only 3 layers when I spoke about this topic in 2006. But I've expanded it to include a couple more. We're going to look at the market and the economy. Those are considered the foundation layers. And you can kind of ask yourself, well, why, Dave, why is the economy at the bottom layer? Why don't you put the market? The reason being, I feel that without an economy, how could you have a market, right? Without people actually buying and selling goods, then you couldn't really have a financial market to boot. So in a sense, the economy is sort of a collection of various markets, including the stock market. We'll talk about how to examine a company's fundamentals and technicals so that you are putting yourself in the position of having the greatest stocks in the current market. This is a new layer that I've added called the it factor. What makes a great stock it? And finally, top it off with knowing yourself. So let's start with the economy portion. You can follow along in your workbook with the page numbers here. Some of the slides are a little bit in different order, but I'll let you know when that happens. So far, we're pretty much on the same page here. Why do the greatest winners in each market cycle change? Well, it's not simply that because the company that gets so big stops growing as fast as it can, in other words, the law of large numbers. It's not only that, or the fact that we have competition that eats away at the number one company, creating this system of new companies coming in to sort of take market share, eat that former leader's lunch. This is a concept that an economist, Joseph Schumpeter, had given to the world. But it's also due to major changes in the greater economy itself. And the better you understand what's happening in the entire economy, what sort of technological innovations are changing the way we do work, or we live, or play, then the more likely, when you come across a great stock, that you realize that this is actually not just simply a great company. This is a representation of life itself and what the economy is doing and how it's changing. And these changes can last for not just a couple of years or so, but for perhaps a decade, if not longer. For example, We go back to the 1960s and 70s. I've just added a few brushstrokes here about what those periods were like for investors. And one was the economy in the United States was growing fast, and so people had a lot more disposable income. So consumer stocks did very well. People were buying a lot more than they were before, say, World War II. We had two oil shocks in the 70s, caused a spike in inflation, but also provided some opportunities to make some big gains in a few oil and gas exploration companies. Air travel was really booming in connection with the industrialization of the United States, and that spawned new markets and industries as well. So, we had big hotel companies that grew and became very big winners in the market, and so I've listed a few of these names. Now keep in mind, if you attended a level 1 workshop, we teach that the average length of a winner from the time you buy it to the time you should sell it is about a year, year and a half. But as you are advanced readers and investors, keep in mind that these big winners will last longer than that, generally speaking. Look at Apple, right? The big breakout happened in 2004, and now it's a stock that has a 500 billion market cap. Incredible run, right? It doesn't mean you have to buy and hold that whole way, but you want to definitely keep it on a core watch list so that you have multiple opportunities to capture that incredible macro trend in the economy. Digitalization, entertainment at your fingertips, computers that you can take anywhere and do anything. So let's move on to some other decades here. These are all quite familiar to us. In fact, the Reagan Revolution spawned so many new businesses. These companies just grew tremendously and provided products that people wanted. It was a great time for growth stocks. And you can see that it was not only just about computers, but we had incredible advances in medicine, the internet, wireless. It was an incredible hotbed of growth, innovation, change, and opportunity for all of us as individual investors. Now we come to a past 12, 13 years that have been a little bit rocky, right? We've had two of the worst bear markets in U.S. history, period. But at the same time, there's been a lot of opportunity. So long as you are in line, in step with the market, you'll find that there are lots of industries that are thriving. We know from crude oil prices. We know from, when I talk about the welfare state, I'm talking about the increase in demand for healthcare, medicine, better techniques, surgeries that allow us to live actively and happily and healthily into our 70s and 80s. My father is a retired physician, and he says, David, you have the chance to live past 100. You've got to be kidding me. Why? Well, he says the advances of technology with robotics and mechanization, computers, could allow people to possibly be able to keep every part of their organ alive so long. He said, I missed it. I'm too old for that, but you are on the cusp. It's kind of a laughable thing, but you have people like Ray Kurzweil who's talked about it and written about it, and robotics are truly a great new frontier for our economy. That's something to look forward to. I didn't include that in here, but it all goes along with the opportunities that are created by these incredible new innovations. And so here I'm talking about consumerism again. We know that people in China, people in Brazil, they're just like us. They like to spend. They like to buy new fancy things. And this is helping the entire economy grow. Despite all the headlines you see about Greece, 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 right? You read the Greece enough, you think that Greece is the entire economy, right? Well, the truth is, it's a global village. Shale oil, shale gas, I think that's pretty self-evident. We have new techniques to find new sources of energy deep in the ground, even within our own borders. We don't even have to go into the Gulf, right? And we find companies that are really excelling in their fields because of that new way of doing things. Smartphones, handheld computing devices are pretty much sort of a continuation of the computerization of our world that goes all the way back to the 60s, and it keeps driving new companies to the foray. Cloud computing, I've talked about this quest for longer life, a healthy life, Brazil, Russia, and so forth. And here's, once again, another list of companies that really reflect how we've really changed as a society and as a people. So, how do I better understand what's going on in the economy? Well, obviously, I didn't list this one, but we always cover the major economic news on the front page of the paper. Not only the key indicators, such as jobless claims or the labor report that came out Friday, but also key trends about taxes, about other issues. But also you want to focus on these other places here. One, the industry snapshot. We have, as you know, 197 industry groups. That's a lot of ground to cover. And our editor, Alan Elliott, does a really fine job of picking the ones that are really showing a lot of strength, unusual strength. And you can capture a sort of a sense of where the economy is going by just looking at the 40 groups within our industry groups table. Has anyone not looked at that table? That's usually on B2. Everyone's familiar. That's what I thought. And so there's constant change in there. As you know, last year, the economy grew a little bit defensive, investors grew a little bit defensive, and so we had a lot of defensive industries leading the top. Food and beverages, alcohol, utilities. You look at that paper now, it's full of vibrant, high-growth industries. So it's changed, almost like a heartbeat. Amazing. Now, you can also read special features in other publications and books. I want to go back to one point I made about the 2010, right here. Retailing specialization. What did I mean by that? Well, it's interesting how these days, although there are some companies that are really thriving in just a general retail business, they sell all sorts of goods, perhaps a little bit lower price, they're competing on price. I've noticed that there are more and more companies, particularly US companies, that just specialize in one category and just do it so very well, and they sort of attach an experience with it. Have you ever heard of a place where you can go in, you have a yoga session with other people, you do yoga, right? And it's in the store. And how can they do it in the store, right? Because all the products on the racks, they're on wheels. So they clear out all the merchandise inside the store, have a free yoga session, and have a session. They sweat together and bond. And then now they're ready to pull out their wallets and spend a lot of money on some new outwear. Does anyone know which company I'm talking about? Lulu, right? Okay, yeah. See? So they are doing what a pair of writers, specialists in retail, have been talking about in this book I recently read called The New Rules of Retail. It's written by two guys who are veterans in retail, Mr. Dart and Mr. Lewis. I don't recommend you to go buy it because I can tell you exactly what it is in just the next minute. All right? But it is a good book. It really is a good book. And they say that retail is going through wave 3 right now. Wave 3 of a dramatic long-term transformation. The first wave goes back to the post-Civil War era until World War II, where as the economy grew, people wanted goods, but there was a limited supply because there are not that many retailers out there. So consumers just had to pretty much accept what was given to them. There was very little price competition. Really, the sellers, it was kind of a seller's market. They could command prices. In fact, could you believe there was a time in this country that when you went to the store, you could not even touch the products. All the products were behind a counter. And you said, I would like some of that. And then the seller would go and bring it to you. And you pay whatever they demanded. Well, that was retail in the first phase. The second phase was the industrialization, the distribution revolution with technology that allowed companies like Walmart and TJ Maxx and Target and so forth really be able to provide a whole array of great products at good prices and create demand because they were very competitive. And that was the second wave that happened from the post-war era to the 2000s. And now we're in wave 3. Now, there's so many products you can buy. We consumers are very, very savvy, right? We can use an iPhone to compare prices once we're in the store. So how do companies differentiate themselves? They attach an experience. They make it an experience. That's what Starbucks did, right? Right? Before they grew into this mega chain, you drank coffee just to get your motor running. But now you go to Starbucks to read a book, meet people, talk and chat, have a meetup group or whatever it may be. It's become coffee as an experience. And that's why they've been doing so well. And that's why they've been able to grow beyond their borders. So this is what I'm talking about when I'm saying reading special features, not only in IBD, but in other publications that you trust. Maybe they have some insights that help you understand the greater framework of what the market is really doing. So now we're going to the market here, and I'm going to be quite quick through this section because, one, we've already talked in detail about the market. I just want to say one of the biggest points is that As you know, a follow-through is the time to have a lot of conviction in the stocks that you select. Because one, the biggest winners tend to take off early, and they make big gains as soon as they break out. And so keep your conviction high at the start of a bull market, and as you're making gains and as the bull market ages, you want to start to be a little more cautious. You reduce your holdings, you start to take profits, and you want to pretty much be timing the market well. You want to be out of any new holdings and make sure you're in cash by the end of that long bull market. So when pessimism swirls around you, that's the time, because usually great follow-throughs happen when there is a lot of fear and people are sick and tired of looking at a stock, let alone buying one. Have a low level of conviction, take your profits. When people around you are bragging about their gains or say, did you get that stock? Did you get that stock? When you see people jogging on their treadmill at the gym and they're watching CNBC, right? Is that a sign that people are getting a little too greedy? So make sure that you are on the right side of the market, meaning you're following the market's action and not what other people think or say or believe. That's really critical. It's interesting how human nature works. The herd, the crowd, tends to be wrong at market extremes. And magazine covers tend to be a good reflection of that. Now keep in mind, like I said about the media is full of very, very bright, intelligent, knowledgeable people who get to travel the world, meet important politicians and businessmen and write what they see. And at the end of the nasty bear market in 2008, Time comes out with this very visceral cover, right? This is October 13th, 2008. It wasn't exactly at the market bottom, but it was getting pretty close. And to their credit, they had a story by a Harvard professor here who said, no, this isn't Depression 2.0. So he's a little bit upbeat, okay? Despite the negative connotations of this highly sensational cover, right? So when you see that kind of fear, or as Baron Rothschild has said, that blood on the street, that's the time where you should be really hunting for that new winner after the follow-through. Not before, but after the follow-through, okay? We also like to use the weekly bulls and bears indicator. This is on the housing market page. I really tip my hat off to Chris on this because he pointed out, after studying this, the way that bulls sometimes will actually be fewer in number as a percentage of those newsletter writers that are polled by Investors Intelligence on a weekly basis. We've noticed in recent decades that when the bulls are lower than the bears as a percentage, here you can see the summer of 2002, we had the dot-com collapse that was near its end. You can see that there was a relatively high level of bearishness, almost 40%. Same thing happened here in 2010. This is just days before the September 1st follow-through, 2010. You can see that bullishness really tanked and at one point was just crossing below the bearishness. So this is a secondary indicator, but it really bespeaks the emotions going on in the market. I wouldn't get caught up in all these sort of sentiment indicators. There are so many, and some of them come in and out of favor. Sometimes they work, sometimes they don't. We've noticed that this one has been a pretty good signal, but we still focus on the market itself. Make sure that you're in sync with what the market is doing. So I talked about friends and neighbors, and you can get a feel for how the general market is doing by just listening to other people who might, especially who might not read IBD. And if people are talking down, including the media, a company that maybe has some fantastic prospects, this is a time where your antenna should go straight up, and you should really take a closer look. And this stock I'm talking about as an example is Google, which started its run back in September 2004. I think this is a really interesting example because it showed how a great company will prove itself even in a time when things are not looking so great. Looking at the market, you had 3 significant sell-offs, 3 waves down, and then finally a follow-through day that happened August 18th. Less than a month later, Google breaks out. Now, some of you might recall that Google got itself in a lot of hot water at that time when it announced its IPO. It's going to go public. People knew that this is a very popular, good website. I immediately knew this is a great company because whenever I tried to search for something, I always found much better results on Google than any other website. So I knew this is really special, and it's in a thriving, new, exciting industry group. Well, there's a lot of negative headlines about this company. The 2 co-founders, right? Larry Page, Sergey Brin, they appeared in some magazine article, and they weren't supposed to because it was supposed to be a quiet period, so they got rapped on the knuckles for that. They decided they were going to do this special kind of Dutch auction of their shares, which ruffled a lot of feathers on Wall Street. So I could imagine how a lot of executives in these big investment banks were sort of feeding negative feedback to the newspapers and magazines about how Google was really doing things strange. Plus, you had a situation where the market was correcting significantly. Not quite a 20% bear market, but pretty close, 18, 19% decline from the highs on the NASDAQ. But what was the reality of the situation? The reality was that this is a company that was truly great. And if you had looked at the fundamentals of this company, which you can get here from the SEC filings, these came from the 424 prospectus, you'll see that this is a company that had phenomenal growth. After it became profitable at this point, it had 86 million shares. And then just 1 year later, 440 million shares. And then another year later, 1.5 billion in revenue. And then very, very strong increases in earnings growth. You can see how the compounded growth rate was just truly exceptional. All right? I put net income here because there weren't any public shares being traded. So we had to look at some measure of profitability. In IBD, we typically look at EPS. But in this case, because this is information prior to going public, we're looking at net income. And you can see, compounded from 2001 to 2003, just 2 years, 288%. Fantastic margin here, good operating margin. A market that was looking down at this stock, media headlines were kind of looking down at it. Well, this stock just catapulted out of this narrow IPO base at about 113. You can see that maybe the IPO price was kind of artificially set low because people had lower expectations about the company, about the economy, about the market. But the demand, as you can see, was so strong that you didn't have to wait, and you shouldn't have waited for a traditional base to form. It broke out in heavy volume and doubled by the end of the year. Just fantastic fundamentals and technicals, which is what we're going to talk about right now. So does anybody remember those headlines back in 2004 about Google? So it's kind of like skepticism, right? Here's this Silicon Valley startup based out of San Francisco. But what I found interesting is that here was a company, just by coincidence, was founded by two guys at Stanford, right? Well, there was actually another company that was founded by two people at Stanford, two professors, who wanted to be able to send emails to each other from computer to computer. And so Professor Lerner and Professor Bosak created Cisco Systems, 1990, you see. And so you never know. You really never know where someone or some team of people are going to come up with something truly fantastic and make it go public and give us a chance to profit from a big run. So let's look at this layer, very, very important layer. It has a lot of material here, so I hope I can get through it in a timely manner. How do we build that conviction? How do we build a real strong belief that this company could be one that's really worth hold, or at least buy several times along the way? Well, we get real. We read a lot, we examine the charts, we analyze those charts, and we listen. We listen to what people say, we listen to conference calls by management to get a feel of the quality of the management there. And so here we have a little checklist that I think might help you really kick the tires in any stock. And very important is to study that weekly chart more than once, because sometimes you gain a lot more information and insight and can decide right there and there, you know what? This is really not it. This is not the one I'm looking for. This is not the stock that's going to double or triple for me. I'm going to get rid of it. Because sometimes what looks like a good pattern ends up not really being such a great one. So look at that weekly chart more than once. Look at the monthly chart to make sure that you're not buying way late in the rally. Great stocks will form bases even on the monthly chart. Okay? Did you read the most recent news releases to see what they're doing that's new to fulfill that N in Can Slim? I'm not saying that you have to listen to many conference calls, but it is good to get a feel for what is on the minds of the analysts who ask questions. What are they worried about? Through conference calls, you might find out like maybe this company is facing a big lawsuit. And if they lose that lawsuit, there could be a substantial hit to earnings, and that would affect your stock. You can get a sense of the quality of the management. In fact, Lululemon, we talked about that. I'm a holder of Lululemon for disclosure purposes. I own shares. I manage a couple accounts that have shares. And the one thing that drew me right away to this company was not because of yoga, because I cannot do yoga. I tell you, I'm the stiffest guy on the street in terms of. Oh, that's right. So I can twist certain ways, but not in like in a yoga fashion. But one thing that really impressed me was listening to the very first time that Christine Day spoke as CEO of this company. And it was not a quarterly news conference, but it was just basically introducing her and a presentation. And what I learned from that were two things. One, here is an ambitious woman. She was a key manager, executive at Starbucks, and had a lot of success. But she knew she could never be CEO because you have Howard Schultz there, right? It was her dream to be the top dog in a great company. And so for her to move to Lululemon was really saying something about not only her as someone who might do a really good job as a manager, but someone who also could make Lulu as successful as Starbucks. And two, I found that as I listened to that short, maybe 30-minute presentation, I realized that even the analysts didn't really know much about the company. There were very few on the call. Analysts can talk about a lot of fine details that really you as an individual investor don't really need to know because you're focused on more important information that's actionable. But I realized that this was a company, although it already had a lot of success in Canada, was just starting to become big in the world's largest economy here, right? We're the world's superpower in spending, are we not? In consumer spending, right? And here's Lulu going to make its debut. So that's what really impressed me about this company and made me an early believer. Have you read some features in IBD? Obviously, the archives in investors.com can help you find a couple recent articles in Internet and Technology or New America, and that can really cement your understanding about why this stock has a 99 composite or a 99 EPS, and no one else in the same industry has anything even close to that. And you want to keep a sort of folder of materials because that folder can be kind of like a mental shield for you. As you get in the stock and you're trying to decide, should I hold through this pullback? Should I be looking for something else? Can I sit through this correction? Well, if you have a folder of materials about this company, charts and some news releases or some like my own chicken scratch I'd write in there would help me stay focused. Remind myself that, yeah, this is a company that really has it. Keep in mind that we want to focus on those companies that are growing fast and also possibly accelerating their growth. If it looks like, based on the most recent quarters, that you're going to go from, say, 75% earnings growth to 50 to 10, that kind of deceleration is a red flag, which often spells the end of a current run. And so you want to be aware of that. You want to focus on those that have acceleration. And the acceleration does not necessarily have to be in the latest quarter. One thing that Bill taught me that really has helped me a lot is that he looks at 4 to 8 to 12 quarters of earnings and sales numbers. And if he sees earnings growth accelerate in, say, the fourth and fifth quarter, and then it falls off a little bit, but it's still very strong, say 50% or 40% or 80%, even if it's slightly down from a triple-digit growth, that's still very good. What you want to be careful about is when that earnings is starting to slow down below 25% and down 2/3 from its peak. That's what I'm talking about here. We use weekly charts, monthly charts to count those bases correctly. In general, you want to be having high conviction early in the run, not only the market, but also in the actual stock itself. So make sure you are focused on first and second stage basis. Justin did a real fine job explaining how we do the PE expansion. I think the little detail about how if you have a sense that this company is going to be beating the estimates by a little bit and you can add that to the earnings to give you an even higher target price, that's a very nice detail that you can use. Now, when it comes to conviction, there's another kind of conviction that's very important, and that is, do the real serious money, the real serious players in the market have conviction, right? No matter how much conviction you have in the stock, if the people who are really moving the stock don't, then you have to act accordingly. And so I try my best in every new buy, before every new buy, to look for those signs of conviction. And if the stock is really trading like a monkey, you know, wide and loose swings going back and forth, 10% swing here, 15% swing there, as it's creating that base, I have a feeling that there's really a mixed set of opinions about that stock within the greater institutional community, and so I tend to back away. If the group is not showing strength, I'm also a little bit nervous, so I like to see stocks that also have a companion in that industry group that are also doing very well. You look at the IBD 50 today, right? This morning I looked at the first 15, and I noticed that about 9 of them are consumer retail related, right? And so here is a group, a sector that is moving strong together. 5 are medical and technology related. There's nothing in utility, there's nothing in transportation, virtually nothing there. And the rest, let's see, there's only 1 oil related stock. But it's just really important to make sure that you are buying a stock that is showing really strong industry and sector strength. Another clue, a telltale sign that maybe the rally is due for a big break or it's over, is that it's rising to new highs and low volume after a big run-up. It's got to be months into the advance. Keep that in mind. That's a negative divergence in price and volume. So I just want to speak briefly about Shanda. This is one of my better investments back in 04, 05. I got shaken out of the stock with an 8% loss after it formed this flat base and took my lump. But because I knew that this was a company that was a real leader in online gaming in China, and I felt that you couldn't have a bigger market than that, when I saw that stock bolt to new highs on even heavier volume, I decided, you know what, I have to put my ego to the side and get back in. And boy, was I glad I did. I was able to sell around 42-ish or so, got about 150% gain in about 3 months. So I was very excited. In fact, I was so excited that when this base was starting to form, I was ready to jump in. But would you have had conviction at this new breakout in June here? Would anyone like to give their opinion about this, this cup base? Sorry? Wide and loose. Precisely, exactly. You know, from a distance, at first glance, at first blush, you're thinking, wow, this is a pretty nice looking cup. Not too far off the high, kept most of its gains. But on second look, when you look at that weekly chart a second or third time, you'll notice that in some of these weeks here, although it's supposed to form that left side of the base, some of these weeks had 15 to 20% swings from the high to low. That's huge. Not only on the downside, but on the upside too. You see this big up week here where it struggled to get above that 10-week moving average? Well, the high of that week was 38 and change, and the low was 32. So a 6-point spread, almost 20% in just a single week. Now keep in mind that some bases in great stocks only fall 20% within the whole structure. Shanda fell 20% in a single week. Okay? So that was a signal that, boy, there's a lot of volatility, a lot of wide swings. I better be careful. Now, of course, this was a high beta stock. It's a relatively new name. You can imagine that people who would buy this kind of stock are probably people who are very, very active traders, institutional and otherwise. And so this stock certainly had the flavor of one that would move very, very quickly. But look at, not only had wide swings, but a lot of reversals and a lot of time here spent at the bottom part of that base. Here, when it formed this flat base, you can see there are lots of tight closes, and the volume on the downside was pretty controlled, but not the case on that side. So you can see that the stock tried to break out. You can see, in fact, you didn't even have to wait for an 8% loss rule to trigger. You could have just gotten out that same week and see the stock go do a round trip. Okay, so Priceline, I'm sure many of you are very familiar with them. They really represent a true macro trend that's occurring to this day, right? International travel. People are more and more willing and eager to visit Latin America, Asia, Africa, Europe. Europeans coming over here, especially when the dollar is so weak, and hopefully the euro will go down so we all now can visit Europe someday, not have to pay $10 for a cup of coffee or whatnot. But here's a stock that, as you can see, had a big run up. What would shy you away from this? Anyone? It looks like it's really strong action here because you had a kind of a deep cup here. Then you tried to break out, but then sort of tightened up a little bit and tried to form a base on base. But is there any problem you would have with this stock? Kathy, is there something you would see that? Extended, exactly. Yeah, look, a big, big run up, late stage base breakout possibly, right? There's a bunch of bases here. You can see 1, 2, probably another one here. And so it's just had a very big run. This is in 2007, before the big bear market in 08. You can see even at this point in time in 07, the numbers were just outstanding. You see the fact that the earnings growth is much stronger than sales growth was telling you about how they could leverage each dollar of sales into higher profit. But there was a little bit of slowdown here, still very good. But the main point of this is that you have to look at the entire run with a weekly, perhaps in a monthly, would show that it was probably due for some sort of rest. Now, on the flip side, we're looking for clues of high conviction, and they would include tight closes, week to week, smooth trading, very few jagged weeks, so to speak, where the stock comes down really hard, makes spikes up and down. You really want to see an absence of that. And then on a week-to-week basis, and this is something we do very, very religiously when we pick stocks, for instance, for leaderboard. We look at the base week to week, and we look, okay, it's down this week. Well, how was the volume? Oh, it's actually quiet. All right, next week. Down was down, but really heavy volume, but it actually fought its way back up to the 50-day or the 10-week moving average. Oh, look at all these big blue spikes, big accumulation on the right side. And so we're getting a sense that, hey, the mutual funds and the hedge funds out there have a lot of conviction. They really believe that this is going to be a great stock. So by using those charts, you're really empowering yourself because you have superior knowledge of what that stock is really doing. And just real quickly, I'm going to look at Google here. We saw the chart at that first IPO base. You can see it just muscled its way to a more than a double, formed a base on base here. And look, you see how even though this stock is trading over 100 a share, a number of these weeks are much tighter. Here's a tight week here, very, very low swing, tight closes, reacting on big earnings. You can see that as the base was forming and finishing up, the volume on the downside was really drying up. This was the second base that it formed. This is in early 05, and you can see that the numbers continue to be outstanding. Nearly triple digit all the way, excellent numbers at the breakout. And then even after forming that second base and rolling up again, you have another very tight base. Look, from 320 down to 270 or so. You're talking about a decline that's less than 20%. Very, very tight action. That's the kind of cup and handle you're looking for. Not something that's very steep and deep and all over the place, but something that's acting very, very quietly as it's taking a break and building that launching pad for a new big move. Now, we fast forward to today. This is a monthly chart that shows that the stock did not do a round trip of all of its gains from the IPO during the 08, early 09 bear market. But as the stock tried to fight its way back, you see that from 247, it's quite a long run just to get up near its peak. You know, you have to almost triple in price. And so it's got the law of large numbers working against it. You see now that because the quarterly sales or the annual sales are growing, it's just so big that it's just harder and harder to maintain that really, really strong can slim growth that you're looking for. Same can be said for the earnings per share growth here. In its heyday, Google being really numero uno in the market, you can see that the growth was just absolutely exceptional. But then come 2008, 2009, the appearance of Facebook, right? The saturation of the internet search market and ads, although it's still growing, it just certainly showed a slowdown, a maturity in its growth factors. So stocks action recently, in recent years, have really reflected that slowdown. Okay, so now we are talking about how to keep that conviction at a high level once you've got a stock and it's, say, up double digits. Making a nice gain for you, but as you know, one of these days, you're going to wake up and you hear some news of either maybe an analyst downgrade, or maybe it had a very, very strong earnings report, but the outlook wasn't as rosy as people had expected, so you see a stock pull back. But at the same time, these corrections are necessary. You need to sort of remove some of that froth in the stock itself and allow it to catch its breath so it can keep moving higher. So always be prepared for these brief breakouts. First of all, right after the breakout, these brief pullbacks, because, you know, you're buying stocks at new highs. We're not trying to buy low and sell high. We're buying at a very high price. So there is an inherent risk that you're taking right from the bat. As many as 4 out of these 10 winners will pull back, shake people out, and keep going. So that's something you have to just be mentally prepared for. And the same goes when you have a double-digit gain that suddenly gets cut in half. What do? Well, sometimes if you are a very active trader, and you might be looking at the chart and the screen several times a day, keep in mind that it's just a day, right? A whole week is 5 days, and a lot can happen on Thursday or Friday. We saw that with InvenSense, right? It fell 24% off its highs. It's an IPO, relatively small stock. It's got one technology. It's not Apple yet. And so it's going to be pretty volatile. But after news came in about a very, very successful price offering, the stock came roaring back. and finished this past week up more than 14, 15%. And so it's a good lesson, real time, as long as you have a decent cushion. And as long as you know that this is one of the best stocks fundamentally, to give it a little time, wait till the end of the trading day or week, take a walk outside. You know, if you're holed in your office all day, right, you're looking at the stock often, or you have your smartphone is giving you all these alerts, so forth. Well, it can be a normal pullback that actually disappears within the weekly chart. Here's some exceptions to that rule. Obviously, if something is really, really bad, some really bad news comes out, or the group is really cratering, the market is really showing signs it's going into correction, then it makes sense to try to nab the profits that you've got. So institutional buying, as I said, can come in and lift a stock by the end of the week. And sometimes it happens after a stock has pulled below, say, the 50-day moving average or the 10-week moving average. Sometimes it lives under that line for a few weeks, and it takes a while for the institutions to get back in. So make sure you give that stock that opportunity to rebound, because if you sell, sometimes it's hard to get back in because of your emotions and because maybe it takes off too fast and you lost that opportunity to get back in. Now, this I think really is very important. In addition to making sure that your stock is one that's actually trading tightly before it breaks out, make sure that you know how the stock has behaved in the past, like Google. Google is an example of a trending stock. After it broke out, it just moved, right? Triggered that 20% gain rule, allowed you to hold it for 8 weeks. It didn't fool around. It didn't come back down into the base. It didn't form base on base and base. It didn't shake people out. That's a perfect stock for a can slim investor. It just keeps moving to new highs after breaking out. Some of these great stocks are whipsawing stocks. They get up to new highs, and then they come down real hard. And I've noticed that with, say, oil, gold stocks, because they kind of behave a little bit like gold and oil prices. Very, very volatile action. There's a company called Direct Focus, which made those fancy $2,000 fitness machines, the Bowflex and so forth. That was a stock that had a tremendous run. But every time it went to new highs, it would cut people up. It would just come down real hard, trigger 8%, and then form new base, do the same thing over and over again. The end result was a big run, but it was a stock that was just constantly whipsawing. It's not really worth your time and your expense. So keep in mind that I really believe that there are two kinds of stocks in the market. Focus on the ones that truly have a tendency to trend higher. So this checklist will help you maintain your focus on your rules. And I really recommend that you make photocopies of this. If you have 5 great winners right now, 5 positions, and you're getting a little bit nervous about the action of one of these stocks, but you don't see any clear sell signals. You're reading the big picture, and it says, still market in uptrend. What do? Well, you got to make sure that you don't sell too prematurely. And so hopefully this checklist will help you keep you sitting tight and holding firm. Quickly, I'll read these. Violating this whole rule? No? Okay, so you stay tight, stay put there. Is it making a normal pullback? Now keep in mind that when the market, say, falls 3 to 5% in just a normal little pullback, the best stocks in the market will fall 1.5 to 2.5 times that. So if we're down 3% like we were in the market just this past week, well, then it's very possible for a leader to fall 10%. That's what things like InvenSense have done. And so keep that in mind, that the best stocks will fall a little bit more than the market, but if it's within normal ranges, then consider that just part of the necessary holding time period. Do you have a true market leader with the potential to gain the way that Google did, with those fantastic fundamentals, with a great story behind it? Now, if you sold after that first correction, make sure that as long as this company is still a big leader, make sure you get back into that stock. You don't want to be sitting on the sidelines as this stock goes from 100% gain to possibly a 200 or 300% gain or more. Do you know enough about the company to be confident in being able to sit there? And did you use charts properly? So make sure that you're paying attention to what the big institutions are doing. Now, obviously, there's a time that you have to turn off the switch, so to speak, right? Where you don't want to be holding a stock and being so convinced that this is going to be the greatest company ever when it's shown signs of topping. And so this is a very, very challenging aspect, knowing how to sell close to the top as you can. All I can say at this point is that truly everything looks really great at the top, numbers-wise, ratings-wise, the story, people's enthusiasm about the company. But you always should remember that you're selling based on technical action. Signs of real heavy institutional selling, new highs and low volume, poor base that forms. And we'll talk about this in the final example of our talk to help tie that together. Former Prime Minister Winston Churchill once got up on the stage and was asked to give a little speech to a group of graduating schoolers. And he got up there and said just one thing. He said, never, never, never give up. And then walked off the stage and got a big applause, right? And so, pretty impressive speech, right? So, my message to you, never, never, never marry a stock. Only date it, okay? All right? Stocks are for dating, not for marrying. And keep in mind, most of our stocks are not going to be Microsoft in the 80s and Home Depot in the 70s and Google in the 2000s. If 1 out of every 5 or 10 are that, that's great. But the rest of them, if you're making a gain, make sure you're locking in those 20% gains. In fact, in the afternoon session, you'll see how incredibly powerful it is to take consistent gains at 20%. Over a year or two, the compounding of profit is just immense, and you'll see that. Well, I talked briefly about what do I mean by the it factor. I've kind of alluded to it already in some ways, but I just wanted to highlight 2 examples of companies that had really had it, like truly the can slim criteria that got people like Bill into a stock. Cisco Systems, you can see having very, very big numbers, and big in terms of not only quarterlies, but also annual growth. We have an ROE on both of these companies. Microsoft, when it was breaking out in '86, also had very, very strong numbers. You can see these are all in your workbook. You don't have to write them down. But just the point being that you have to find the stock that really has the best growth in the entire industry, in the entire market. That's what you got to go. You have to really aim big. Now, you see that there's a little bit of deceleration here in the prior quarters before the stock made its move in 1990. But keep in mind that before this 300%, there were smaller increases. So there was a period of acceleration that really would have gotten your attention. Now, I've asked the team at Market Smith to build this screen, which is based on the fundamentals and technicals that Microsoft and Cisco had at their first stage breakout, to see, are there any companies today that are showing the same kind of fundamentals? In fact, there are. So I hope you get a chance to look and see what comes up. I would like to note that in the past, we used to talk about only looking at companies that went public within the past 8 years. Now we've extended that to 15. So if it's 2012 today, we're going back to 1997. This was a decision by Bill, and I think it's a very wise one because it reflects how the economy has grown so much across the world that there's a greater demand for basic products, whether it's metal ores or mining equipment, things like that have been around for ages, right? So by increasing the time span of companies in terms of when they went public, we're really widening our net to include other industries now that might have been kind of traditionally mature, but now are actually very dynamic. Now, if a stock is like Apple, right, the stock is really it. You know, it's got some other features. One, it's most likely selling something that everybody wants, right? When I go to Chipotle down in Marina del Rey, I'm amazed. Every time I go there, I see almost every sort of kind of person possible. What I mean by that is I see adults like me, okay? People are just working professionals. Then I see policemen going there for a quick meal. Then I also see families bring their kids, sharing a little burrito salad. There are a lot of college kids who go there. There are people who go on dates there. And I've seen people older than myself who go there and trying something new. It's just amazing how a burrito, right, can have so much appeal, right? And so keep that in mind. Think about the company itself. Does it have broad appeal? Or does it have the potential to sell not only in California, but in Arizona, and New Mexico, and Texas, and Louisiana, and so forth? Can it make a great sensation, make a name for itself, not only in America, but possibly in other countries? And this is very important because I feel that the greatest winners, when you look at them, they truly addressed the needs and desires and wants of a large audience, right? Keep in mind, too, that there are companies that also have a risk of getting knocked off the leadership rung because a new technology comes into play. Garmin was a good example of a stock that was really kind of an it stock. It had it because it had this fantastic navigation technology that really resonated with drivers and hikers and people who were hunters too. But over time, it fell to competition from cell phones, right? Because now cell phones can tell you where you are, like with Google Maps and so forth. So keep in mind, particularly with technology, it's interesting. Retail might not have the same sort of situation because we have a lot of successful discount retailers, right? You've got Dollar Tree. They only sell $1 items, right? But you also have Ross stores that sell name brand merchandise at lower prices. And you got TJ Maxx, right? And you would think, well, wouldn't they make each other obsolete? No, because it's not necessarily high tech. It's other factors that have made them great leaders and put others out of business. Here's just another quick example. Sun Micro was a big winner in the 90s. The servers that were helping to fuel the internet were selling like hotcakes. But then now, after the dot bubble crashed, by that time there was a glut of these products. They became commoditized. You can buy them online for really cheap. And virtualization technology has allowed businesses to be able to get more out of their own servers and therefore reduce demand. So keep that in mind in terms of technology plays. I want to talk a little bit about that final layer of the pyramid, knowing yourself. Yes? Absolutely. Great question. In case you didn't hear it, could you talk about how do market leaders pull back? And if they pull back more than the market, doesn't that seem sort of counterintuitive? Shouldn't they pull back less? I'm going to address that question a little bit, an example of Netflix. But in general, like I said, we found that during a market correction, say if it's a 10% correction in the market, the NASDAQ or S&P, then the best stocks will also take a break after bringing their big run up, and they'll fall maybe 15%, 20%, or 25%. And that's within the parameters of normal cup bases, double bottoms, and flat bases. Now, there are cases, indeed, as you're right, when the market might be just truly collapsing, like it did in '08, down 50%. But some of these other stocks also corrected, but not as much. That's where a stock can fall less than the market and show strength. But what I'm talking about is after a stock is broken out, is making a big move, you can expect a little bit bigger pullback because it had a much bigger gain. But you'll see that more in action with the Netflix example. You might want to sort of know yourself better. If you already know what kind of sectors you're quite good at, then this is really not a necessary exercise. But I found that it's important to know what kind of sectors you have more comfort feeling, because perhaps you might be better able to sit through those little pullbacks and declines than in a sector that you don't really have much knowledge of. And for me, I've always wanted to improve and expand my knowledge because I think a successful investor is one who's kind of a generalist, right? They know at least a little bit about industrial sectors or medical sectors. Not to the level of an MD, right? But at least know, oh, this company is addressing really, really serious needs in certain diseases and so forth. And I think the more you read and learn about these sort of sectors by using IBD, I think the more confidence, more conviction you'll be able to build in new leaders. And Justin talked about this a little bit. Sometimes some stocks keep you up at night, right? Or some stocks you just know, I'm going to sell at the bottom, right? That was a great comment by Justin. And I think it really is important to know your threshold of tolerance in terms of swings. And so what you could do when you're looking at a stock, like you look at Shonda, right? Had a 15, 20% swing week to week. Take this formula, basically figure out how much is swinging from the high to low and so forth, and then give a rating to each one of those. I know from my past that I tended to have stocks that in the past were very, very volatile. A good example was JA Solar that I had some success with in 2007. I knew that this was a 3 or high volatility stock. And going into it, knowing that I knew that this was going to be a wild swinger, helped me actually stay with it as it pulled back right to the pivot point. I remember having to buy it twice. I lost money the first time. But then the second time, I had a nice cushion. It was up 20% or so. Then it came down almost to like maybe a 3, 4, 5% gain because there was some bad news in the sector, maybe an analyst downgrade. But I stuck to my guns, held on, and the stock tripled. It was a great ride for me, a great stock in a very, very strong market in 2007. Well, it's funny that one of those weeks that it fell really hard, a week later I bumped into a friend who was a money manager, and we talked about JA Solar. And he said, you know, I sold it on this big down week. And I asked him, why did you sell? Oh, I heard about an analyst downgrade or something like that. But I'll tell you, I didn't say anything about what I did. I was just listening to his story. But I wasn't surprised. I wasn't surprised by his action because one, I knew he was the type who tried to trade as many different stocks as possible without spending the time to really learn about the actual company. And what helped me with that company and holding that stock was a New America article I read talking about JA Solar being a leader in making solar cells. They didn't do anything else. They didn't make the modules. They didn't make the ingots that you use to slice to make the solar cells. They just specialize in solar cells. And I don't have a PhD in chemical engineering, or I never came from the solar sector, but I learned from that New America article that they were the only company at the time to offer a 25-year guarantee on the reliability of their solar cells. And that insight was very, very important, very, very critical to my being able to sit and hold that stock until it made a nice gain. So I hope these ideas keep you aware of all the different things that are going on in the market day to day, not only with yourself, but with the stock, with the company, the market, the industry, and the economy. I told you about a couple of my winning trades. Now it's time to talk about some of my bonehead trades. And Netflix was a big, big mistake on my part because, one, I might have invested only once in it when I should have been really tracking it, as it made a six-fold move from 50 in 2009 when it broke out to 300 just last summer. Six-fold move, okay? What does the company do, right? Puts these little DVDs in the mail, right? Sends them out to you. How can a company like that grow six-fold? What's going on? Well, let's try to answer that question. So looking at the economy itself, the company went public in 2002. This was a year after the tragic 9/11 events. Since 9/11, we saw a new trend in society. It was nesting. People tended to stay at home more. And because they tend to stay at home more, they got a little bit bored, right? So what do? Well, I'm going to go see a movie. But I don't want to go out. Oh, here's a service called Netflix. They will send you a DVD through the mail, and you don't have to worry about sending it back late because there are no late fees. Boy, I can choose from among 10,000 titles. Wow, this is better than Blockbuster. I don't have to drive out there and get the DVD. I just pay a low monthly fee, and I can see any movie I want. Here's a company that was taking advantage of a new market opportunity. People spending more time at home, but people need to be entertained. They want to watch something. And so Netflix was there to provide a brand new way of enjoying movies and video. So here you have, not only that, you had other trends coming into play. One was the price of DVD players fell below $100. And when something falls below $100, it tends to be just bought by the entire masses. Not only that, especially in California, you had a growth in home theater systems where people, they spent a lot of money to build their own little mini theater at home and then watch these movies as if they were going to the movies, right? So this nesting phenomenon, this constant, never-ending desire for entertainment, and an economy that really was making people look for value, put Netflix in a pole position to be a leader. We had a follow-through in March 2009 that yielded big gains. Most investors were shell-shocked, including the professional ones, but we had the tried and true market signals that told us to get into a company. Now, the fundamentals were outstanding. Prior to Netflix's breakout, you can see that we had a little bit of a dip here, but then acceleration, acceleration again. These are the quarters of growth right before. Notice now, before the stock broke out in September, there was a slight deceleration here, but we had already shown a record of acceleration. So keep that in mind. And this is also above that 25% minimum that you're looking for. Great numbers on the annual earnings side. Earnings expected to grow fabulously. The one concern might have been the RS rating, 69. But that really represented just a minor blemish. Remember, not every stock is going to be absolutely perfect. We're looking at so many different criteria: fundamentals, technicals, market, the company itself, management, products, competitors. If there's one or two little errors, so to speak, or little shortcomings, you might be able to overlook them, especially when the market is really moving up, really moving strong. 69 actually is not that bad. It's in the top third of the market in terms of 12-month stock price performance. And the average RS rating for the great winners when they start their runs is around 80, 85 or so. So 69 is just sort of representing the low end of that average, okay? Some great stocks are going to break out at 99 RS. Some are going to break out at 69. More importantly, it had the entire package. That's why it appeared in the time saver table here, October 16th, 2009. High price stock, $50 a share. We don't mind that. In fact, it's better because it means it's more liquid for institutions to get in. Good numbers all around, 97 composite. You had a B accumulation and ASMR. Industry group's doing pretty well. Well, anyone care to guess how many articles we've written about Netflix since its debut in 2002 until today? Just throw out a number. 60. Pretty good, pretty good. Still not close, though. We actually wrote 97 features. 97 features about Netflix from 2002 until this past week. Most of them are obviously in the internet and technology field. Some are New America, some are Investor Corner. And that's not even counting the little small briefs and mentions in columns such as Stocks on the Move or in our tables. It's just quite phenomenal how much coverage. It's phenomenal how I missed the stock. I mean, here I'm working at IBD, I'm reading newspaper every day, right? The only excuse I can give is that our editor-in-chief, Wes Mann, he's been with IBD from the beginning. One day he said he went back home, pulled out the newspaper, and his wife was complaining, "Why are you looking at the newspaper? You work in a newspaper." And he says, "I'm busy. I don't have time to read the news," okay? So that happens. A golden opportunity right at your feet. We don't want to miss those. And so anyway, this is just one pair of articles that truly show the essence of Netflix's wonderful business model. They offered a prize, the Netflix $1 million prize, to any team of engineers who could find a way to improve their recommendation service by 10% or more. Because part of the success of a retailer, so to speak, or a consumer products company is to not only get someone to try the product, but then to like it and come back and have that repeat order, okay? And these recommendations that people would get as they went online to manage their account or browse through the library of TV shows and movies really made a difference in their top and bottom line. In fact, my friend Pat Seitz, who's a wonderful technology writer and assistant editor for the tech section, we've seen movies together in the past. He wrote about his own testimonial, saying, yes, this new technology that they awarded some team $1 million to improve really does work. He watched a movie, a very serious sports documentary called Hoop Dreams, and Netflix told him that you ought to see Triumph the Insult Comic Dog. What are the connections between the two, right? Well, it turned out he loved it. He said, I sat down, watched it, I loved it. Pat, being the very, very thorough, consummate reporter he is, he got Reed Hastings, the CEO, online, asked him about this. And Hastings says, I personally gotten some odd recommendations that he ended up loving. I got a recommendation to watch Jimmy Carter, Man from Plains. Gosh, I hope Bill's not here. And I said, oh my God, how boring. My own company is telling me I got to see a documentary about Jimmy Carter? I was so surprised. From the title, I would never have picked it. But he said, you know what, it was good. He said, why would I possibly watch a film about a failed politician, blah, blah, blah. It was really good. So anyway, the point is, it was a hit. They were a new company eating Blockbuster's lunch, eating the mom and pop video stores' lunch, and then continuing to revolutionize themselves, make them continually new, just like what Apple is doing, just like what Lululemon's doing, and so forth. So we had another article that happened just a few days after. It was the earnings report. You can read it on the way home. But what's interesting is that the stock actually slipped a little bit after hours, but that's not what it did in the real market. In fact, you can see on that day, the day after it reported Q3 results and Pat's quarterly report article came out in the paper the next day, the stock was really kicking into high gear. Before that, we had the breakout from a good cup with handle. You see how the action tightened up very tightly on this daily chart. Heavy volume in the time saver table. Two features about the recommendation service. This was article number 57 or 67, somewhere on there. So here again, you know, should have gotten this one. And it just made a big move. So here again, you can use that checklist to make sure you're really focusing your time, your energy, and your money, your hard-earned money, into the best merchandise in the market. Now, at this stage, We're at a daily chart, and we're hopefully going to address this gentleman's question about how to handle these pullbacks. And I want to go back to that first chart. Here, in fact, it did not trigger the 20% rule within 3 weeks. So you could have gotten out around 60 and 20% gain. And that actually would have been the right move, because the stock then made a new base that ended right here. And then the stock bolted again, huge volume on another strong earnings report. So you've got to buy in the gap up. This is also forming a high handle there. You can get back in. But let's suppose you held it. You still got it at 50. Or you bought back at 55 even. Now, in just a few months, you are up more than 100%. You're enjoying these bullish gap ups, which is always a good sign, except if you're into a climax run. Plus, you're getting support. Now look here, 109 or 119 even more dramatic. You're going from about 120 to 90. That's a 30-point drop in just 5 days or so. So you're talking about a 25% decline. And that's probably coinciding with, say, a 5–10% drop in the market. And so even though you have a big profit cushion, you got to be ready for these pullbacks. And you have support at the 50-day, support at the 50-day again, and this time you don't. But it's not a sell signal for several reasons. One, as I spoke about, we have a very, very nice 100%, almost 100% profit cushion. We can give this stock some more time. Two, some stocks take a little while before they come back and reclaim that 50-day moving average. And in the process of doing so, we actually found ourselves with a new buy opportunity. This is a new base, a breakout from a double bottom. It was a little bit choppy. Here again, what I say, even though you got a great company, you got to be prepared for pullbacks. 4 out of every 10 great stocks. It happens. It happens to the best of them. And that's what happened to Netflix, but it never triggered 8% loss rule. Had nice support. You can see that the volume on the down days were overshadowed by the up volume on the breakout. More gap ups, continued support. At this stage, you're up more than 200%. Here again. Now, everyone has a bad day in the market. We sell too soon. We miss a breakout. Don't give up, right? No one cares. No one cares if you sold a stock too soon. The market doesn't care. The market doesn't know you or me. Let's suppose you sold Netflix at 100. What is going to prevent you from getting back in that stock? Only yourself. Don't take it personal. Very important to just stick to the best winners. That's where you're going to make the big money. That's where you have the chance to really compound your gains. Don't settle for something that's second class. Who cares? Who cares you bought and sold, bought and sold? Ideally, you want to be able to buy it at 50 and sell at 300. But we're not all perfect, right? But if we can participate in a stock from 50 to 100, and then 150, or 100 to 200, we're going to be very happy, okay? What did I say about stocks and marriage? Don't marry them, okay? So Netflix was certainly one that you had to have a pretty serious date. It was a pretty long day here. You have many bases here. These are the ones that we covered right here. This is the one, the first one you saw. Went up 20%, then made this big pullback, but then you just got to be ready. You got to be willing to put more capital, fresh capital to work when it moves like that in huge volume, new highs, nice strong uptrend. But here we come across a very timely sell signal around the time where they're talking about Netflix going to raise their prices on their plans and cause a lot of people to vote with their feet and say, I'm getting out. I'm canceling my subscription. It was an uproar, right? This was the year of Occupy Wall Street, right? You just did not want to tick off the society or the public, okay? Even with movies. So you had a 2 weeks down, 3 weeks up sell signal. This is a V-shaped base. This is really, really well covered in chart school. If you've never been to that seminar, it's a gold mine in terms of really understanding all these different sell signals. And this is one that I personally learned. I knew the sell signal. I didn't catalog it as a 2 weeks down, 2 weeks up, or 1 week down. I just saw it as a V-shaped base, a faulty base, because it was less than 7 weeks. But this is what we call it. 2 weeks down, and then 3 weeks up to new highs after a significant correction, late stage base, market in a choppy, back from correction to uptrend to pressure and back and forth. Last year was tough. And you can see, boy, this was a great sell, because not only are you locking in your gains and showing a real maturity and understanding of the market? You're selling at sort of like a Livermore whole number, around 300. Often stocks tend to sort of peak, or they start to break out, and they peak at round numbers. And that's what happened with Netflix. So missing all those gains in Netflix, I decided that the leisure movie area, or at least leisure products, is some sector that I really want to get to know. Because of the utter destruction in value in banking, as far as I can tell, I think we're all going to continue to use ATMs and credit cards and have bank accounts. So I figure, well, there might be some growth opportunities in the banking space, especially as the home building sector continues to rebound. Every sector is going to have its day in the sun. So I'm pretty confident that banking would be one. I've never worked at a bank, don't know much about banking, but I'm a consumer. I assume everyone else is, so why not learn something about it? So I'm starting to read a book by Mike Mayo. He was one of the guys who said that the subprime debacle is something that's really going to be serious, and I'm learning a lot by reading that book. Well, any last-minute questions? Okay, yes, sir.
What's the accuracy of earnings estimates?
Well, the question is, how do you look at earnings estimates? We at IBD, especially our markets team, look at two sets. We look at the current quarter or next quarter, and we look at the full year. And most of our screens of stocks in the paper are looking for companies that have at least 15% earnings growth for the entire year. So you have at least some sense. There's a confidence within the Wall Street community that the company will continue to grow. It's not slowing down. But keep in mind that estimates are just estimates. It's not part of Can Slim. We're looking at evidence of really strong growth, and estimates only provide a little bit of a peek into the future. The estimates are also usually very conservative because company management does not want to overpromise and underdeliver. They want to underpromise and overdeliver. Now, you might recall Apple was a stock would always say, oh, we're expecting this amount of sales. And that sales estimate for next quarter was always below the street estimate. But the stock oftentimes would barrel higher. Why was that? Because, well, the street knew that was very, very, very low. But no analyst would dare try to put their estimate much, much higher to the truth of what it may be because they fear being shut off by the company. See, if you're the CEO and I say, I think you're going to earn $5 a share, and inside you know you're going to do it, but you got a lot of pressure. And then you cause a herd mentality where everyone says, oh, no, I think it's going to be $5.25. And that expectations grows far beyond their control. They will shut you off. So do not pay too much attention to those estimates. Pay more attention to the stock chart and the market. One more question.
At some point, do not sell order in.
You mean in terms like stop orders?
Yeah.
Stop orders are very helpful if you travel a lot. Since I work at IBD, we have real-time access to quotes. We look at the market hour to hour. It could be a liability, in fact, right? Because if the stock is down 2 points, we think, oh, is this the end? No. It could just be a little blip. But if you're away for a week and you know that a big piece of news is coming up, like an earnings announcement or something, or the market is under pressure and it looks like it could tilt into correction, it does not hurt to use stop orders. At least set a minimum profit you'd be happy with. But don't set the stop orders too tight because there have been many times, especially with very thin traded stocks, the market makers will come and grab your order. They'll take the stock down to trigger your order and then bring the stock back up. It's happened to me, particularly with companies that trade, say, 300,000 shares or less. That's why in IBD, we pretty much feature only those companies that have 400 to 500,000 shares of trading because your little small stop order is not going to trigger it. I think what's more useful, though, would be to print out the chart, see where you're at, count the bases, look at a place where you think, this is where I probably would sell, draw a red line there. And then when that stock penetrates that line, maybe then you start seriously about taking some profits.